Syme here with another video broadcast. Today's topic is convertible promissory notes. Sounds technical, but when you learn about how these things work, it's great for the entrepreneurs and it's great for investors. So I think it's important that our clients and potential investors understand this vehicle and understand what a great idea it is for a lot of very early stage companies. So first of all, by way of background, I am a California securities attorney. I do have an MBA in finance, and I am a FINRA registered investment advisor. So let's go into sort of what a promissory note does. Here's the problem. A lot of our clients have a devoted fan club, customers that love them, investors that love them. They call them up and say, hey, how would you like to invest $100,000 in my company? And the investor says, sure, I'd love to. How do we do it? Am I buying stock? What am I doing? I don't want to loan you the money because I really want to participate in the company's growth. So how do we do this? How do we come up with a fair price? It's very confusing. Well, the answer is it's almost impossible. The problem is valuing a young company is so hard. It's so speculative. And here we have a bunch of average business people that really don't have the skill set or the time or the focus, even if they do, even if they are, highly skilled at this stuff, they may not have the time and energy or care enough to put in to figure out what is this stock really worth. So we have a solution to that problem. The convertible promissory note goes this way. The investor loans $100,000, for instance, to the company. The company takes it as debt. Okay, now, a year from today or 6 months from today, after the money's been spent, after a lot of great things have happened, after the next part of the story unfolds, eventually we're going to wind up with a company that is very valuable, that has an ascertainable value, and as an investment advisor, which I am, part of my job is to spend weeks or months trying to decipher and defend the concept of what the share value ought to be. Now at that point, the company is very much more valuable than it was when the initial $100,000 got put in, and the company is very much more quantifiable. It may have sales, it may have all kinds of new benefits that are attributable to the company, and now we can put a formal valuation on it. Plus, I may have spent a month working up that valuation and defending it, and people may be very persuaded by it at that later date. But at the early date, it's a very tough. It's a crapshoot. I mean, who the heck knows? So the way this works is the investor puts the $100,000 in immediately, and they get a promissory note back, just a loan, and it may carry a rate of 5%, 10%, 15%, who knows? That's negotiated between the people. And that's just regular debt. But with it comes the right to convert at whatever the first round of sales of stock are with a discount. And that discount may be 10%, maybe 15%, maybe 20% off whatever the eventual market price is. So whatever price it turns out to be, that investor's $100,000 turns into that investment with a discount. That's a pretty nice deal. So what that says is, we don't know the value today, but give me the money, and when we do have a value, you get the original IPO stock, and there may not be that much of it. It may be hard to get because a lot of entrepreneurs don't release very much stock initially. So getting in on that ground floor is a way to guarantee you have a seat at the ballgame. Okay. So that's what convertible debt is, and that's why basically the entrepreneur calls up one of his fans and says, hey, how would you like to give me $100,000? The guy said, love to. How do we do it? Convertible note, give you a promissory note, then you get to convert at a negotiated discount back of whatever the eventual market valuation is. That is the basic overview of a convertible note. Now, one of the questions that everyone should be asking is a convertible promissory note a security? Well, that was a very hotly debated topic, and no less than the United States Supreme Court actually rendered a verdict on that. And they said that, in fact, yes, it is. The Supreme Court said, look, we don't care what you call it. You can call it a bond, you can call it a promissory note, you can call it a stock, you can call it a duck if you want. We don't care. What we care about is what was the intent of the parties when they did the transaction. And the Supreme Court found that the intent of the parties was to do ultimately a stock transaction. You know, they asked the investor, if all you were doing was giving a loan and getting it paid back with interest, would you have done the deal? And the guy says, heck no. I wanted a piece of this company. I wanted to go for the ride. I wanted to become an owner. And the Supreme Court said, well, that's the intent that carries the day. Therefore, yes, it is a securities transaction. For that reason, we need to avail ourselves of one of the safe harbors, which is Reg D, typically 506, which permits us to sell a security, which this is, without registering the security. Now, that imposes upon us a few limitations. I'm not going to go into all of them, but the major one is it makes it so that only accredited investors can go ahead and make the investment. An accredited investor is a guy that makes more than 300 grand a year if they're married, or has net worth of $1 million or $2 million, excluding their house. Basically, a fairly rich guy, not a billionaire, but a guy that is wealthy enough that if he loses his investment, the SEC kind of says, well, to heck with him. He'll be okay. He's not going to be on welfare. So what happens is you can only sell to accredited investors. Now, with that limitation of accredited investors, under the Regulation D safe harbor, you do not have to make all of the disclosures that might be in a private placement memorandum. So it really cuts down on the paperwork, cuts down on the disclosures, and makes it a fairly simple 2 or 3 document transaction. My law firm can help prepare the documentation and help out with the documents that are needed if you have a fan club that would like to get involved in this. Now, there's one more wrinkle that is an interesting one. There was a startup, the name of which escapes me for the moment, but I think it was Uber or one of those that really shot, I think it was Uber actually, that shot through the roof. And the investors said, look, when I got in, the stock was worth $1 a share. And by the time you guys went public, it was the equivalent of $500 a share. And I got my money put in at $500 a share. I missed out on that whole run-up, but I was one of your early investors at $1. I should have got more than just the right to buy in at 20% back of $500. I should have been able to get in at, I don't know, $10, $20, $50 a share and gone for a lot of that ride. It was a fair complaint. So for that reason, a lot of people have put in ceilings. In other words, the investor won't be, when the investor does convert to common stock, he will do it at a price that is no more than a certain number. That's a tough number to come up with because, as we discussed earlier, we don't really know what the company's worth yet. We don't. And saying, well, I'll give you a ceiling of $5. Well, that makes a lot of assumptions about what the company is going to turn into. As an investment advisory, we can give some advice on that, and it's possible that we can come up with some kind of a ceiling. Because a lot of the companies that we work with wind up becoming quite valuable, and that cap idea is not ridiculous. Let's now switch to a different topic. If I'm an investor and one of my companies that I love comes to me and says, hey, give me 100 grand. I say, sure, I'd love to. I love your company, but how am I ever going to get paid back? What's my exit strategy as the investor? And unfortunately, the response to that question is often a lame one. What it is they say, earnings. We are going to earn a ton of money and you're going to get your money back out of earnings. It's a tough argument because most startups are always cash strapped. They're always struggling. They're always expanding. And there's never any money to pay back the investors. So now your money is trapped in a company that's not publicly traded. They're privately traded shares, which makes it hard to get rid of them. They have Rule 144 restrictions on them that say that you can only sell under certain circumstances, that you have to hold them a certain period of time. You can only sell to certain types of people. It's a tough sell with a privately held stock. I am affiliated with Tartan Capital Advisors, and one of the things that we do for our clients is we are in a position to actually take those companies public. We actually register the shares under some brand new securities rules that are much quicker, like it takes like 90 days, much less expensive, costs like $500,000, and it's fairly easy to do. It's designed for small businesses. And what that does is that says, hey, Mr. 100, okay, once again, I'll be the investor. Hey, Mr. Investor, your 100,000 is going to convert into common stock when the Regulation A plus go public occurs, and you're going to be sitting on publicly tradable stock. Now, how do you like it? Now you ask me, what's the exit strategy? The exit strategy is you got common stock, you can go sell it on over the counter or whatever. You can sell it through the market makers. It's registered for trading to non-accredited investors. Wow. And how long before that happens? About 90 days, 100 days, 120 days. Depends how long the audit takes. That's really the wild card in the process. Oh, so if I give you 100 grand, I'm going to be holding stock in about 6 months that, you know, given Rule 144 holding periods and that sort of thing, but fairly soon I will actually be allowed to sell it on the open market and get liquid again. That is correct. The next question I as an investor say, what assurances do I have that you really are going to go public? I love that idea. I love the go public. I love the liquidity. I love the exit strategy. How do I know you're actually going to get there? And the answer is, as the investment advisor, I and my group, Tartan Capital Advisors, are actually going to do the work to take the company out. We're actually going to take them public. They're going to go public because I say they're going to go public because I'm going to do the work. So a lot of the money that the investor is putting in is earmarked for the go public effort. So what do we know? We know that if the investor puts the money in, the company has pledged to put that money toward the go public, and that guarantees, essentially, you know, it virtually guarantees that the company will in fact go public as long as they continue to want to. Let me dispel one misconception that people still have. In the old days, the states had what's called a merit review. And the merit review said, we may or may not approve your stock for trading, for sale to our state customers. In fact, Apple was denied in 12 states for the merit review. The new Regulation A+, which is brand new, it's only like a year or two old, has no state merit review. All it has is the federal review, which has federal preemption. The states are knocked out of the game. You do not have to worry about the states, therefore you do not have to worry about the merit review. How good is that? So once again, if you pay your money, you get public. So let's take the chain of events. Entrepreneur calls investor, give me $100,000. Investor says, why should I do that? Answer, because your $100,000 is going to be used for the go public under the new Regulation A+ rules. Oh, so that money is earmarked just to go public and get me liquid? That is correct. How do I know you're going to make it? Because Tartan Capital Advisors says I'm going to make it, and they're the guys that are going to get the money. They're the guys that are going to take me public, and that's why it's going to happen. Wow. So we have essentially a straight shot to the IPO, a straight shot to public trading, and all the additional liquidity that comes with that, which also boosts the value because in a Regulation A+, we can raise 20, 30, 40, $50 million of additional capital for the company. What's that going to do to the stock value? Okay, that kind of wraps up the things that I wanted to talk about. Long and short of it is, an investor who gets in on a convertible note where he has assurances that that money is then going to be used to fund a go public, and he will then have tradable common stock, and the company that he's invested in just got a massive infusion of capital, it might turn out to be a pretty good investment. Okay, If you have questions about this, feel free to give us a ring. The number should be right here with the magic of video. We look forward to talking to you more about it. I hope some of that makes sense to you, and I hope we can make you some money on one of these deals. I'll talk to you again on the next video. Take care. Bye-bye.